Okay, let's go ahead and do the multiple choice review. For those, and so let me get a let me pull it up here. Well, wait, before you do that, just to let you know, then we're going to do the sampling practice exam, which you should be able to get through, and then maybe start on the chapter 16 handout, end of audit procedures. Okay. All right, so this is the, okay, let me start a poll. And just so you know, a lot of this stuff on the a lot of these things for like I think all these multiple choice questions are actual CPA exam questions. Inventory obviously has been audited for many Neat. Is there anyone still working on the multiple choice questions? All right, I think I'm gonna go ahead and close it. Now, some of you are having trouble logging on, so we'll make accommodations for that. Okay, so let's go through. All right, so I'm gonna close the poll. But yeah, there is a little bit of a glitch here. Okay. All right, so let's take a look, see. Number one, the correct answer is D. Just like you guys said there. Yeah, and so the key here is that every check. And so you're gonna audit from the checks. This first one might look right, but if you go from the receiving report, there might be a check for every receiving report, but there might not be a receiving report for every check. All right, let's go to 2. See purchases. If you record the purchases, then the inventory would look higher than it really was. 3.
Professor,
Yeah.
can't it also be D for that question? Because if customer returns merchandise that is not damaged and can be resold, if that's not added back into the perpetual inventory, it could also throw off the count.
You know, I know exactly what you're saying. That would be a sales return. If they had sales return and not recording sales return.
Oh, I see. Okay, never mind.
Yeah, no,
I got it.
No, but it's a good point. A sales return, if they don't record sales returns, that could definitely do it too. And actually, I was on an audit that we had that situation. Okay, which of the following is not one of the independent auditors regarding examination of inventories? C. Oh, no, wait. No, I'm sorry, D. This is D. Verifying that all inventory owned on the client is on hand. It may not all be on hand. Okay, yeah, 4. A. Close one. Yeah. Owned by the company, is in possession of the company. They may not be in their possession. It may be out on consignment. It could be out for delivery. That's FOB destination. I'll tell you a weird one to that. I was at US Steel, and usually it's FOB shipping point where you put it on the truck and then it's sold, or it's destination. It's whenever it gets to there. We actually had some stuff that was FOB to a railroad terminal, and after the train passed that railroad terminal, then somebody else owned it. And that was kind of, back in the day, it was really hard to tell when the trains had actually passed that point. And it came down to that the people we were selling the steel to owned that railroad. So once it got on their railroad, they owned it. So it was like this really weird, it wasn't FOB shipping point, it was like FOB terminal, whatever, in Kansas or whatever it was. Spending like half a day trying to figure out where the train was. I'm sure it's easier nowadays, but back then it wasn't. Uh, see, if the company holds title of the merchandise. All right, 6. Which of the following is customary procedure for the verification of legal ownership of real property? B and D are the two best answers. D is the actual correct. You generally look and see what they have on hand. There can be a delay in public records. And so, especially if there's something that's new, it's been added. So what if they have the deeds on hand, it's usually better. Who picked E for number? Who picked E for this one? Number 7. There is no question. Yes, there is. Oh, actually, maybe you say no. There's no answer. Okay. The auditor are least likely to learn to try to repent through the following. Yeah, hey, these other ones are all ways of figuring out about it. When something stops being depreciated, that could mean that it was retired. Analysis of the debits to the communication depreciation account. Debits remove the depreciation account, so that might indicate that they've removed that piece of equipment. And review insurance company riders. If they've taken some equipment off of the insurance policy, that indicates that maybe they don't have it. And I think I told you, retirements are always the tricky one, because there's a lot of times there's very little documentation. And I'll tell you another weird one about that. We had a plant, this is in Springfield, Ohio, when I worked at Navistar, that they had all this equipment that they had taken out of the plate, you know, put in new equipment and all this, and no one had taken it off the books. Now, when equipment, big equipment is in a plant and it's bolted down the floor, it's considered what they call an attachment. It's considered part of the building, part of the, you know, part of the real estate. And so we actually, our property tax was based on, you know, not just the building, but also the attachments to the building. Those are all attachments. We're talking about millions of dollars worth of stuff. And so we were getting taxed on, right? And so once we, you know, once the auditors figured it out, by the way, it was an audit that I was on, property, plant and equipment, which I thought was gonna be really easy, and it turned out to be a nightmare. But anyway, they had to go back and, like, you know, try to reclaim these property taxes going back. I forgot how many years they could go back, but it was like 5 years or something like that. Because of all this equipment that we were being taxed on, as if it was still in the building and still part of our whatever, was gone, and they never recorded it. No one ever thought that it was considered an attachment that would be taxable for property taxes. Okay. It's funny, when accounts with are most likely be most likely to analyze for details. Repair and maintenance expense, because if they're major repairs and maintenance, they might be capitalized. Okay, number 9, which is the most important control procedure over acquisition of property, plant, and equipment? Using a budget. It doesn't sound like much of a control, but actually, if it goes on the budget that it's going to be purchased, that's one of those major things you look at. And if there are things that are purchased that aren't on the budget, we're talking about large things, for property, plant, and equipment. So if they're not on the budget and they're purchased, then you wonder why they were. Something had happened. I'll tell you something about that too. Property, equipment, are tries to determine all the following except. Yeah. Yep, very good. That was good. Very, very, very good. We stop sharing. Let me save that. And check your email, make sure that you have the this is a chapter, before I start babbling and what I'm doing, let me get this done. And again, if you didn't get that in, I know that people are having trouble with. Okay. All right. Yeah, no, there is, this is only, I think this is the only time it's ever, one of the only times it's ever happened was, that I kind of threw up my hands. They have, our budgeting at Navistar was called appropriations. And I was given the task of going through the appropriations and seeing if they had all the stuff they were supposed to have, their documentation is and evidence of why they're buying it, whatever it was. And literally like half of them were completely just made up stuff. And I didn't know what to do with it, because this place also had a system there. They had all these people sign off. It was a really weird system. There was 9 managers in the plant. This is the same plant in Springfield. They had 9 managers on it, and they all had to sign off on everything. So you got all these people signing off on stuff, but no one was really reading anything because there was 9 people signing off on it. It was actually a control weakness. I wrote it up as a control weakness. They also had that for purchasing. They would purchase everything that was purchased, had to have all 9 managers sign off on it. But anyway, so no one was actually checking anything. And a lot of these things that got approved, like, okay, here's the reason for doing it. They were just approved for just Mickey Mouse reasons. Not that there wasn't legitimate reasons, but in the actual appropriation, there wasn't. So it was a very strange thing. It was only one of the only times that I didn't know what to do, and I could tell my supervisor didn't know what to do either, because we never really came across it. You think, okay, maybe I'll find 1 or 2, not like half of them. Okay. Second. All right, let me save that. Okay, before I go into the sampling thing, I'm gonna. Wait, you can't even see me? Yeah, I guess you can. I want to tell you this about the way my auditing career started out. It was kind of odd, and what kind of feel like what kind of transpired. My first job was with Navistar, and I showed up in January, and they were trying to keep me busy for 2 weeks because after 2 weeks I was going to go to an audit that was I can't remember. I think it was in I think it was in Canada. It was uh, in Ontario. But anyway, so they're kind of keeping me busy, and they got my computer. I got that all set up. I got learned how to use the modem back then. You had to have a modem to get And so getting all this stuff worked out, and I had contacted the supervisor and that. So this had taken a few days. So there's still time left over. So this one older manager that was there, they said, give him something to look at, see if he, see what he does with it and all that. So they gave me these expense reports, and there were 6 of them. So they gave me these 6 expense reports to look at, and these are for sales reps for the company. Actually, they did training of sales reps for if someone had a truck dealership, they would go train their salespeople on selling the trucks, I assume. But anyway, they had these expense reports. So these people were flying all over the place. They were flying, staying at hotels all over the country. So of the 6, like 4 of them were pretty straightforward. They'd have everything in it. There was 2 of them that were just a stack of random receipts, the expense report, and he couldn't really make heads or tails of this thing. Now I know that that's like a red flag for fraud, but back then, it was like, hey, I can't figure this thing out. This is, there's receipts that are from this time and this time, and I don't know where it is. So I decided to make a timeline. Especially for this one. This one was, so I made this timeline. And it became very apparent that this guy was flying his family around and going to Disneyland and all kinds of stuff while he was doing something else. So you'd have receipts that were from Orlando, Florida, and you had receipts that were from, San Diego, California on the same day. He ate dinner in Orlando and he ate dinner in, San Diego on the same day. And it just became, it's just obvious. And it looked like it was padded. This expense account was padded for about $6,000 a year. Right. So I bring that into my supervisor. I said, look, there's this, I found this one, and he said, here's the timeline, and there's all these receipts, hotels and stuff that he's staying in 2 hotels in different sides of the country at the same time. I said, this is obviously not, possible. And so they look, oh, okay, all right. So, the wheels start turning. All of a sudden, it really was like a big deal. And I was kind of freaked out by it because it was all of a sudden like the director of internal audit, and you had accounting people coming in and stuff. Oh man. So anyway, while that's going on, I started doing the other one that was kind of messed up, and lo and behold, find the same thing. It's even more. I think it's like 8,000. The timeline, and it's obvious that there are people going all over. There's things being expensed that have nothing to do with the company. So anyway, so this is my first. It's literally my first 2 weeks on the job. This is like my second week. And all of a sudden, and by the way, they talk about these reps, these sales, training reps. There was 6 of them in the company, and the 2 that I got that I found were the best, like far and away the best 2 in the company. And the first guy that I gave the report, about was, one of the most popular people in the company. Everybody knew this guy. Everybody. And literally for my next 2 years when I was doing an audit, people would come up to me, oh, you're the one that got, Bob, whatever his name was. You know, he got, him fired. And I like, well, no, I didn't get him fired. He got himself fired. But yeah, I was there. So anyway, it really turns crazy kind of after that. Now, so I gave all the stuff to the older gentleman that was the audit manager, and they take all this evidence. They go to these people's supervisor, who was actually the vice president of sales, and the vice president of sales had signed off on all the expense reports. So the vice president of sales says, well, I had no idea I was supposed to look through those. I just thought that I had to sign them. There was nothing actually written on there what the signature of the supervisor actually meant. It just had the employee's signature and it had the supervisor's signature. He said, I thought that was this, so I knew what costs were going out or whatever. And he said, I had no idea I was supposed to look at these, which kind of indicates why it could probably happen. Someone probably, a lot of times they'll test the water, put in an extra receipt for something. And after a while they say, okay, no one's looking at these. And then they just go all out. So anyway, so you had this the supervision that really wasn't there. So that was kind of eye-opening that, here's this big company, this big, industrial company that it just seemed very loose, I kind of couldn't believe that no one knew, what they were really doing there instead of supervising and all that. So anyway, the first guy is the first guy up, and he is the most popular guy in the company. I don't know, by far. He was just very well. And by the way, there is this really weird thing that comes over you when you walk by their desks and stuff, and you see that there's his kids have this world's greatest dad picture and all this kind of stuff, and you realize this is going to affect a lot of people that have nothing to do with it. I suppose it's the same thing that police go through. I'm sure it is when they arrest somebody and they have kids or whatever. But you go, oh man, it isn't like you jump up and go, woohoo, I caught this guy. It's not like that. And then it turned even stranger in that, because this guy was so popular that it went round and round with human resources. They actually ended up giving him, he was let go, but they gave him 6 months severance pay, which is a lot. I can't remember exactly what he made, but it was something like $20,000 back in the day. So, really, and by the way, this is a salesperson. So they probably got to walk out the door and got a job someplace else because they were the top salespeople. So then when the next guy came up, well, everybody knew what they had given the first guy. So the second guy comes up and says, no, I want 6 months severance pay. And they gave it to him. So now I'm wondering, why am I even here? But anyway, that's what happened with those two. And even an odder twist is that the manager that gave me the expense reports had already audited them and had missed those two. I guess he just didn't, follow the program, whatever that, or I don't even know what. But anyway, so now this guy, this audit manager, he doesn't like me because I showed him up or whatever, which I had no idea it even happened. It was a very strange start. And this happened in the first 2 weeks I was there. Now, luckily, there was, to some extent, it kind of blew over after a little bit. But anyway, certainly on the next audit for the next few months, but right up to the last audit I was there, 2 years later, there's people coming up to me and saying, "Oh, here's one that got those, whatever they, Bob and Brian, whatever they're." Actually, I do know what their names are, but you got these two guys fired. Now, one other thing I want to point out to you is that it's very important if you go into auditing, and that is how you write up something. And this is very important. You never, well, let's say for instance, I found these two people, padding the expense reports, embezzling money. You never accuse anyone of a crime in your report. When you write it in generic terms. You don't name people. Sales rep submitted expense report that had expenses that were not for the company. That's the kind of writing you wouldn't. You don't say Joe whoever is guilty of embezzlement. Why don't you put that in there? Why don't you put it in there that this person stole money? I know this person stole money. Here's the evidence. I know they stole money. Why don't you put that in the report? Anyone?
They like liability.
Yeah, that's libel or slander. I mean, if you got to remember, even though maybe you have a tremendous amount of evidence showing that they stole money, if you accuse them of a crime, crimes are only, accusing someone of a crime is that they did not commit is slander. And when you get tried for a crime, it's beyond, you'd be proved guilty beyond a reasonable doubt. So someone say, well, okay, if they sue me for slander, I'm just going to go to court and I'm going to prove that they took this money. You can't prove a crime in civil court. Civil court is preponderance of evidence. You can't prove a crime. You can't get them convicted of a crime in a civil court. So even if you prove that they took it, it doesn't matter. You accuse them of a crime that they've never been, found guilty of. So you never accuse somebody of a crime. You're not a judge. You're not a jury. You're not any of that. So you do not put that in. And sometimes you'll hear people say, I remember this guy got caught stealing money, and he turned around and sued the place, and and he ended up winning. Well, of course he did. They probably accused him of a crime that he didn't commit. He had never been convicted of it. And people say, well, what if they get convicted of it later? When you said it, there was they weren't convicted yet. You can still be sued. So long story short, when you're writing these things up, even if you do find somebody, you write it up in very generic terms. Now the question is, what do you do after that? So once you find somebody, and let's say that you're in a company that maybe doesn't have standard procedures for this. What you can do is take your evidence to the police, give it to the police, and the police will decide whether they are going to prosecute this or not. And the police will get the evidence, and they will, they're the ones that will have, if it's a criminal case, they're the ones going to have to do it. So, and again, you still don't accuse them. You simply go there with the facts. Here's the facts, and let the police do what they need to do. Sometimes they'll take the case on, sometimes they won't. But anyway, that was my first introduction to it, and it is kind of a strange feeling though, when you see the human aspect of it, of when you find something like that. Okay, let's go to what are we doing next? Sampling practice exam. Okay. I don't think this will, well, I'll see how long it takes. And my reason for doing this, I used to just give the exam, and quite honestly, a lot of times it became apparent that I was not as thorough as I thought I had been. So this audit sampling practice exam is kind of setting up a little bit for what you're going to get for the auditing exam, sampling exam, excuse me. These are all auditing exams here. Okay, so let's take a look at the first one. Test the controls. weird. I think it's my speaker. Are you guys getting a weird feedback on my speaker? On my microphone? All right. All right, let's go with the first problem. So this is test controls. And we had 300 purchase orders. We allow for 6%. All right, what was the error rate for the test?
5%.
Yep. All right, so the error rate was so the error rate was 5%. Okay, now the allowance for sampling risk is 3%. So the upper limit, there's a lower limit too, but we're more concerned with the upper limit. Will be the 5% plus the allowance for sampling risk of 3%. Let's make that green. That's not a percent. Hold on. Okay. So the upper limit is 8%. Now, the lower limit would have been 2. I'll put that in. You can ignore that though. You know, we aren't worried about the lower limit, but I'll put that in just because in auditing there would be a lower limit. Oops. So a lower limit would have been -3. If this is a two-tailed test anyways. But this upper limit is the one we're worried about. This is the important. The upper limit is that this could be off by as much as 8. Okay, so the acceptable error rate is 6%. So can we rely on the controls?
No,
Nope.
because it's exceed the upper limit.
Yeah. Yeah, the upper limit. Now, people say, what about the lower limit? The lower limit doesn't really come into play here, and it depends whether it's a 1-tail test or a 2-tail test. Anyways, we're not going to get into that. But the upper limit is when you add that in, that allowance, and say, okay, this could be off by as much as 8%. So our error rate, acceptable error rate is 6%. So no. Now, if the upper limit was lower than the acceptable error rate, you could. All right, so let me just. So the upper limit, if it's higher than the acceptable, you can't rely on it. Now, when that happens, that means you have to do more substantive testing. What was the misstatement of the purchases? It's unknown. A test of controls. What are they saying? Pest controls cannot predict dollar amounts of misstatements. There are yes/no tests. And I'm going to say one more thing about test of controls. If the test of controls are not working, if there is a significant internal control problem, does that necessarily mean the financial statements are misstated? So suppose you're going to have some. What was it? What were we doing here, anyways? Testing for. Requires a department manager signs all the purchase orders. So if there's purchase orders that weren't signed, does that mean the financial statements are misstated?
No.
No. It means the controls aren't there. You can't rely on the controls, but it doesn't mean necessarily that they're misstated. So when you have a problem with test of controls, it's not the same as a problem with substantive testing, because these are not dollar amounts. It's simply saying we can't rely on these controls. Now, if you can't rely on the controls, it's not the end of the world. You simply have to do what with the substantive testing? So you wanted to rely on these test of controls. So you took 300 items, 300 purchase orders, you looked at them. And if you had been okay with that, you would have used 500 in your substantive testing. But we're not okay with the controls. We took those 300 and it just happened to be that we can't rely on the controls. So we were planning on taking 500 if we could rely on the controls. So what do we have to do? Do we have to take more substantive tests or less? Items, I should say, for substantive tests. For dollar amounts. Oh, come on, flip a coin. More or less?
More.
Yes. Yeah, so those will take more items for substantive tests to make up for the lack of controls. You do test of controls because hopefully it'll reduce the number of substantive items you get. You only do it if it's more efficient. So the other will take more items to make up for the lack of controls. Example, I'm just making this up, but maybe they take 1,100 items. Okay, we can't rely on these controls, so we're going to take a bunch more items to do it. I just made this number up. I'm sure you have some way of coming up with what the number needs to be, but let's take 1,100 items. So we'll test it more. And again, just because the controls cannot be relied upon does not mean that they are misstated. Is this test required? I should say test of controls. Required by the AICPA? No. No, you could, instead, if you wanted to just ignore the controls and say, okay, well, look, and I don't want to test the controls, or maybe it'll take too long to test the controls. We're just going to jump right to the 1,100 items and take that instead of the controls. We'll be just as happy. If we tested the controls and took 500 items, or if we just took 1,100 items, we'd be just as happy. So, no. Test controls are only required. The auditor will be relying controls. And usually relying on the controls to reduce substantive testing. Okay. So they are not required, but they're only required to reduce the substantive testing. Now, the substantive testing is required. You are required to get dollar amounts. I don't know if I mentioned this or not. It also kind of came out of the Sarbanes-Oxley time. As crazy as it sounds, there were people in auditing that would say, look, you just have to audit the controls for larger companies. If the controls are working, then you can rely on them and you don't really have to do any substantive testing. That was, I can remember seeing articles on that about how, as long as the controls are working, well, test the daylights out of the controls, and if they're working, hey, you're done. They found out that, well, no, that's not really the case, because if management is purposefully misstating the financial statements, testing the controls isn't going to do anything. The limitation of internal controls, you have management override. But I can remember that. So, but anyway, substantive testing is required. So test controls are not, substantive testing is required. Testing for the dollar amounts. So these are just controls though. And again, controls don't necessarily mean the financial statements are misstated. Okay. Oh, geez, I'm way late. Oh, I'm sorry, you guys. I am blabbing away. All right, let's stop here. Let's say be back at what time is it? 7:11, 7:21. How about? I'm so sorry, guys. If I do this in the future, just I don't know, throw a shoe at me or something. Let me know. Hey, you're boring us for over an hour. All right. This is substantive testing. Dollar amounts. And so this is where we're looking for material misstatements. Okay, and by the way, this is typically the way that they would have it on the CPA exam. This is a lot of times you'll see it in this kind of condensed form like this. Sometimes I'll just give you the audit average and the book average, but sometimes they have you do this, but they usually don't have it. It's not usually very involved. That's about as involved as it gets. Okay, so mean per unit is the same thing as average. And the average that we think is the best is the audit average. Let's make these different colors to keep them. All right, so we take the audit average, $50. We say, okay, everything in that, all those 8,000. All those 8,000 items, those 8,000 accounts receivable, every one of those is worth what we came up with. That's what the book, the projected value is. So this is the projected value. And what's the projected misstatement? Projected misstatement would be 380 is for the projected misstatement is 20,000. Is that an overstatement or understatement? Do we think that they should have their book value they show is 380? Do we think it should be more or less? You guys are sleeping, aren't you? I can tell. It's understated. Oh, wait a minute. Let me see. We're saying it should be 400,000, they only have 380. Okay, ratio estimation. So this is the projected value, and the projected misstatement is 15,833. Find some money here. Difference estimation. We're saying everything is off by $2. So $2 times 8,000. Oops. Equals 16. This is projected misstatement. Understated. So this should be 396. Difference estimation, the weird one about that is that the projected misstatement is the first one you get, rather than the other way around for the other two. Okay, monetary unit sampling, get the sample size. They have had this on the CPA exam, so. No, I don't know whether they will in the future, but they have had. All right, total misstatement is. If people get this one wrong, it's almost always because they have this, the risk of incorrect acceptance. They have the wrong number in for that. So check and make sure that you got the right. You know. So it's 231 and it is. Expansion factor is 1.5. 231. So on the test, be careful. I almost always use 10 or 5, but be careful which one I use there. All right. I get a sample size of 41. You want to check that? And sample size would be. Or so the interval would be 500. I'm running off the nearest dollar, 12,195. Another thing, make sure you subtract this. The expected misstatement, but times the expansion factor. And you'll notice that the higher that this expected misstatement is, the bigger the sample is going to be. And at some point, if it gets large enough, you're not going to want to use this method because you're going to have to take too many items. Just as an example, if it was, say, more than 30,000 for these two, it'd be infinitely large samples. So, okay. Now the one that's going to, this first part here actually is going to cause the most grief to the most people. I hope I'm wrong. I hope everyone gets it 100%, but in the past, this has been the one that's the kicker. Okay, first one. The audit value is higher than the book. This is an overstatement. This method is not supposed to find overstatements, and when it does, it ignores them. Projected misstatement is 0. This one. Looks well behaved. Forty divided by 200. 20%? Okay. All right, so the projected value for this would be 1,000. And the projected misstatement would be 4,000. This one. The book value is more than the interval. So we take the actual misstatement. Oops. So the projected misstatement is 1,200. Okay, we're going doing this at 10%. Our basic precision, and our basic precision is if we didn't have any errors. You know, what could these be misstated by? Because this is a sample. It's a sample, so because it's a sample, yeah, we would multiply 5,000 times 2.31. Why I got these spaced so far? Yeah. All right. $11,550. Okay, calculate the incremental allowance. Now, there's actually only one that we need for the incremental allowance. Here. Incremental allowance means that there's something else that could go wrong. And for the first one, it's not wrong anyways, and it wouldn't matter even if we did put it in, because 0 times anything is 0. The second one, you'll notice that there's only 200 in the sample of the $5,000 that are in there. So there could be more things wrong with that one. This one, everything in this $5,000 interval has been sampled. This is a 100% sample. even more than 100%, but it's one of all of the $5,000 in here. Our sample covered the entire $5,000, so nothing else could go wrong in that. From that one. So we really only need one of these incremental allowances. So coming down here, we really don't need these last two. All right, so see from our table. 3.89 minus 2.31 minus 1. So this is our factor. And we're going to multiply that by. The rules are we get the largest misstatement that's on the incremental allowance, but in this case, there is only one, it's 4,000. So our incremental allowance will be 0.58. 2320. And so we add all those together, that'll be our upper limit. $19,070. And that is it. Hey, we're even done a little early. Okay. All right, I'll send that out, the exam out later on. I think I might make that due in 2 weeks rather than 1 week. So the one that we have, the chapter 12 and 13. You know, I think I might just mail it out next week, just to keep things not confusing. I'll mail it out next week. If you have any questions on it too, we can go over that. Okay, guys. Sorry for keeping it too late for the break, but anyway, I will talk to you guys next week, and next week we'll start it on chapter 16. All right, have a good night.
Have a good night.
Thank you.